Hello, we are Maria Alejandra Martinez, Gabriela Tovar, Laura Rodriguez, and Mario Suarez, and we are going to talk about the credit risk. So it is important to know that in this chapter, we consider another important risk for financial institutions, that is the credit risk. It arises from the possibility that borrowers and counterparties in derivative transactions may be default. It discusses a number of different approaches to estimating the probability that a company will default and explains the key difference between risk neutral and real world probabilities of default. In first place, we are going to talk about credit ratings. So, as we can see, the rating agencies such as Moody's, S&P 500, and Fitch are in the business of providing ratings describing the creditworthiness of corporate bonds. For example, we know that the best qualification that Moody's can be is AAA, and the best qualification that S&P or Fitch can give to a company is AAA also, but Moody's have some divisions in a rating category that are also shown as A1, A2, and A3. And it is important to know that, for example, the equivalent for BB plus in S&P 500 is in Moody's A3, and also in Fitch it is BB plus. And it is important also to mention that only bonds with ratings of BAA in the Moody's rating or above are considered to be investment grade. So now that we talk about this, we are going to talk about the historical default probabilities. So as we can see, there is a table that shows the average cumulative default rates, and this is a typical of the data produced by the rating agencies. It is shown that the default experience during a 20-year period of bonds that had a particular rating at the beginning of the period. The probability of a bond defaulting during a particular year can be calculated from this table. So for example, we are going to take the qualification or term of BAA, and we are going to see the year 2. So the probability of a bond defaulting in this rating and in the year 2, it will be 0.49 minus 0.17. That is going to be of 0.31%. In this table, we can also see that for investment grade bonds, that are the ones that are above BAA, there is an increasing function of default probability versus time. This happens because the bond issuer is initially considered to be creditworthy, and the more time that elapses, the greater the possibility that his financial health will decline. In the other hand, for bonds with a poor credit ratings, the probability of default is often a decreasing function of time. This happens because for a bond with these ratings, the next year or the 2 next years may be critical. The longer the issuer survives, the greater the chance that its financial health will improve. Taking this into account, now we are going to talk about the hazard rates. Okay, so now we are going to talk about the hazard rates. From the table that is in the presentation, we can also calculate the probability of a bond on defaulting. For a qualification of CAA or below, for example, in a term of 3 years, we can show that the unconditional default probability, that is the probability of default during a year, in this case 3, as times 0, is going to be 38.68 minus 29.38, and that is going to be 9.29%. Now we can also calculate the probability that the bond will survive until the same year, and this will be the difference between 100% and the average cumulative difference rating corresponding. So for example, for the third year, the probability that the bond will survive will be 100 minus 38.68. Or, for example, in the year 2, the probability that the bond will survive in the rating of CAA will be 100 minus 29.38%, and that is going to be 70.61%. Now we can calculate the conditional default probability for 1 year period, and it will be the division of unconditional default probability and the probability that the bond will survive. But this is a problem because we don't want to know always the conditional default probabilities in a period of 1 year, but also we want to know from the hazard rates for a length of period of time greater than 1. So for this, we are going to see the formulas that are in the presentation, knowing that VT is going to be the cumulative probability of the company surviving time, that lambda of T is going to be the hazard rate at a time T, and that the delta T is going to be the period of time. Knowing this, we know that the cumulative probability of the company surviving in a time of T is going to be exponential multiplied by minus the integrate from 0 to T of the hazard rate, and the probability that is going to default, that the bond is going to default, is going to be 1 minus the cumulative probability that the bond will survive. Now we are going to talk about the recovery rates. When a company goes bankrupted, those that invested money generally claims against the assets of the company. Talking about bonds, the recovery rate for a bond is normally defined as the bond's market value a few days after a default, or also as a percent of its face value. As shown in the table of the presentation, historical data on average recovery rates for different categories of bank loans and bonds in the United States are shown. For example, we can note that the bank loans with a first lien on assets had the best average recovery rate, and for bonds with an average recovery of 49.8 are those that are senior secured bonds. We also need to know from the recovery rates that these are significantly negatively correlated with default rates. That means that, for example, a bad year for the default rate is usually double badly for the recovery rate, because it is going to imply a lower recovery rate. For example, when the default rate for a non-investment grade bonds in year is of only 0.1%, the average recovery rate might be relatively high at 60%. Now we are going to talk about how to estimate the default probabilities from bond prices. So the probability of default for a company can be estimated from the price of the bond it has issued. The only reason a corporate bond sells for less than a similar risk-free bond is the possibility of it to default. As we know, in the presentation is shown how we can estimate this probability, where lambda is the average hazard rate per year, S refers to the spread of the corporate bond yield over the risk-free rate, and R is the expected recovery rate. So for understanding this, we are going to take an example from the book. So suppose that a bond yield 200 basis points more than a similar risk-free bond, and that the expected recovery rate in the event of a default is 40%. The holder of a corporate bond must be expecting to lose 200 basis points. So knowing this, we can calculate the probability of default for this bond like 0.02 as the spread of the corporate bond yield over the risk-free rate. And we can use the 40% as the expected recovery rate. And that is going to be the probability of the default, that is 3.33%. Now we know that the risk-free rate is a key issue when bond prices are used to estimate default probabilities in the meaning of term risk-free rate and risk-free bond. We know that there are multiple ways to make a proxy to this risk-free rate. And one of these is that traders usually use LIBOR's divided swaps rate as proxy for risk-free rates when they are evaluating their derivatives, but they are also used when they are calculating default probabilities. For example, when they determine default probabilities from bond prices, the spread that is shown in the equation of this presentation of this slide, ds, is the spread of the bond yield over the LIBOR divided by the swap rate. Also, the free risk rate, the risk-free discount rate used in the calculation in this table is the proxy with the LIBOR divided by the swap zero rate. Also, a very important approximation to the risk-free rate is the LIBOR divided by the swaps minus 10 basis points. This estimate is possible taking into account the short-term loans and the default risk premium for a EE-rated short-term instrument. Finally, we are going to talk about the asset swaps because in practice, traders often use asset swaps as a way of extracting default probabilities from the bond prices. This because asset swap spreads provide a direct estimate of the spread of bond yields over the LIBOR divided by the swap curve. There are three possible situations. The first one is that the bond sells for its par value. The second one is that the bond sells below its par value. And the third one is that the underlying bond sells above the par value. So to explain this, we are going to consider a situation where an asset swap spread for a particular bond is quoted as 150 basis points. So in the first situation, its par value is going to be 100, and the swap then involves one side of a company paying the coupon on the bond on the other side of the company. Now, in the second situation, the bond will sell by 95 basis points because the swap is then structured so that in addition to the coupons, the one company pays 5 for each 100 of notional principal, and company B pays LIBOR by 150 basis points that were the initial of the particularly bond. And the last one is that the bond is sold by 108. This because the swap is the structure so that in addition to the LIBOR plus 150 basis points, the company B is going to make a payment of 8 for each 100 of principal of the outset. Then the company A pays these coupons that the company B has given to them.
We will now talk about comparison of default probability estimates. As it was shown previously, there are two different ways to estimate default probabilities, from historical data and from bond prices. Usually, the probabilities estimated from historical data are lower than those estimated from bond prices. The difference between these two was particularly big during the credit crisis in mid-2007, due to the fact that corporate bonds yields increased, increasing the credit spread as shown in equation 23.2 and resulting in high probabilities. Nevertheless, now taking into account this crisis, default probabilities calculated from bonds are bigger than those from historical data. An example will be shown that illustrates this. The historical default probability will be calculated for an A-rated company with the help from this table, specifically the 7-year column, as the comparison will be made with bonds that last 7 years. As we know from the first equation shown, we know that lambda 7 is the average hazard rate by the 7th year, and Q7 is the cumulative probability of default by the 7th year. Therefore, by looking at the 7-year column, we replace the values and we see that the answer is 0.17%. Therefore, this means the average 7-year hazard rate is 0.17%, which is calculated from historical data. In other words, the probability of default at the end of the 7th year, on the condition of no earlier default, is 0.17%. Now, the same probability will be calculated from bond prices. The bonds taken into account have a life of 7 years. The recovery rate is about 40%, and the average yield of bonds during December 1996 and June 2007 is 5.9955%. On the other hand, as it was said before, the risk-free interest rate is the 7-year swap rate minus 10 basis points. Therefore, the average 7-year swap rate was 5.408%, and minus the 10 basis points, we obtain an average risk-free rate of 5.308%. Finally, replacing the equation, this gives us 0.0115, or in other words, 1.15%. This means the average 7-year hazard rate is 1.15, calculated from bonds prices. As it is seen, there is a significant difference between the two methods, where the bond prices probability is much higher than historical data. Now, the next table shown on the left shows more comparisons of this type. We can see that the ratio of hazard rate from bonds and hazard rate from historical data increases as the credit rating increases, and the difference decreases as the credit rating increases. Now, on the next table, on the right, the excess return over the risk-free rate earned by investors in bonds with different credit rating is shown. We can see from comparing both tables that as the difference of the hazard rates is lower, so is the excess return. However, the table on the right is not constant over time, and this can change during periods of time. The default probabilities calculated from bond yields are risk-neutral probabilities of default. This means that the probabilities are adjusted for risk. For this reason, the expected default losses can be discounted at the risk-free rate. By contrast, the default probabilities calculated from historical data are real-world default probabilities, as they are based on actual facts. Therefore, the expected excess return in the previous table, which was in the last slide, arises directly from the difference between real-world and risk-neutral default probabilities. If there wasn't excess return, the real-world and risk-neutral probabilities would be exactly the same. As it is known, as there is more risk, there is more expected return. Therefore, there will be an excess return comparing real-world and risk-neutral probabilities. The difference between the real-world and risk-neutral default probabilities can be attributed to the fact that bonds do not default independently of each other. Throughout time, default rates can be very low during a period of time and very high during another period. This constant year-to-year variation gives way to systematic risk, which cannot be diversified away, and as a result, there has to be an excess return for bearing this risk. Therefore, as there is systematic risk and excess return, the default probability calculated from bond prices is adjusted for risk, resulting in a risk-neutral probability which will be different from the real-world one. It can also be added that the default variation can be caused by overall economic conditions, or it can also be caused by a default in one company, which has rippling effects resulting in defaults in other companies. Due to the fact that there is real-world default probability, which is associated to historical data, and risk-neutral default probability, which is associated to bond prices, the following question arises: which one should be used in the analysis of credit risk? Usually, when valuing credit derivatives or estimating the impact of default risk on the pricing of instruments, risk-neutral default probabilities should be used. On the other hand, when carrying out scenario analysis to calculate potential future losses from defaults, real-world default probabilities should be used. We will now talk about using equity prices to estimate default probabilities. When estimating a company's real-world probability of default, we usually rely on the company's credit rating. However, these ratings are not revised frequently and therefore are not as accurate as they seem. This has led to some analysts to argue that equity prices can provide updated information for estimating default probabilities. There is a proposed model by Merton where a company's equity is an option on the assets of the company. First, suppose that a company has a 1-0 coupon bond that matures at time t. We define V0 as the value of company's assets today, Vt as the value of company's assets at time t, E0 as the value of company's equity today, ET, value of company's equity at time t, D, which is the debt repayment due at time t, sigma V, which is the volatility of assets, and sigma E, which is the instantaneous volatility of equity. If Vt is less than D, then the company will default on the debt at a time t. Otherwise, if Vt is greater than D, the company can make the repayment at time t, and the value of the equity at time t is Vt minus D. Therefore, this model gives the value of the firm's equity at a time t as the maximum between Vt minus D and 0. This expression shows that the equity is a call option on the value of the assets with a strike price equal to the repayment required on the debt. Therefore, the Black-Scholes Merton formula expresses the value of the equity today as E0 is equal to V0 n of D1 minus D times exponential to the minus RT plus times n in function of D2, where D1 and D2 are given by the equations showed on the slide. The value of the debt today will be equal to V0 minus E0. The risk-neutral probability that the company will default on the debt is equal to n of minus D2, where n is a normal standardized distribution evaluated in a certain number, which in this case is minus D2. Usually, V0 and sigma V are not provided. However, if the company is publicly traded, E0 can be obtained and sigma E can be attained from historical data. Therefore, in the previous equation, we have two unknown variables, V0 and sigma. By using Ito's lemma, which is the last equation shown on the slide, we know that we now have two equations for two unknown variables, and therefore the system can be solved. By solving this system, we can obtain the value of D2 and then the default probability. To illustrate this more clearly, we will show a brief example. Suppose a company's equity is 3 million and its volatility is 80%. You know that the debt that will have to be paid in 1 year is 10 million and the risk-free rate is 5% per annum. Therefore, we have that E0 is equal to 3, sigma E is 0.80, R is 0.05, T is equal to 1, and D is equal to 10. We put this value into the equations shown below and we solve the system, and we obtain that V0 is 12.40 and sigma V is 0.2123. On the other hand, the parameter D2 is 1.1408, and therefore we find that the probability of default is 12.7%. The market value of the debt is 12.40 minus 3, which is equal to 9.40. And the present value of the promised payment of the debt is calculated as it is shown in the formula, and we obtain 9.51. It follows, we find out the expected loss, which is calculated with the formula shown, and we obtain that it is 1.2%. Finally, the recovery rate is calculated with the following expression, and we obtain that the recovery rate is 91% of the debt's no default value. This merchant model, which we have shown, can be extended different ways, and usually this model and its extensions produce a good ranking of default probabilities, either risk neutral or real world ones. This means that this probability is a good estimate of either the real world or risk neutral default probability. It can be strange to take a default probability that theoretically is a risk neutral one to calculate a real world one, but the underlying assumption is that the ranking of the risk neutral default probabilities of different companies is the same as the ranking of the real world ones.
Credit risk in derivatives transaction. The credit exposure on a derivatives transaction is more complicated than that on a loan. This is because the claim that will be made in the event of a default is more uncertain. Consider a financial institution that has one derivatives contract outstanding with a counterparty. Three possible situations can be distinguished. The first one is that the contract is always a liability to the financial institution. The second one is that the contract is always an asset to the financial institution. And the third one is that the contract can become either an asset or a liability to the financial institution. An example of the first one is a short option position. In this category, the financial institution doesn't have credit risk. If the counterparty goes bankrupt, there will be no loss. It is likely to be retained, closed out, or sold to a third party. In the second category is a long position, where the financial institution will always have a credit risk. The financial institution has to make a claim against the assets of the counterparty and may receive some percentage of the value of the derivative. Finally, in the third one is a forward contract, where derivatives may or may not have a credit risk. If the counterparty defaults when the value of the derivative is positive, to the financial institution, a claim will be made against the assets of the counterparty and a loss is likely to be experienced. If the counterparty defaults when the value is negative to the financial institution, no loss made because the derivative is retained, closed out, or sold to a third party. Adjusting derivatives valuations for counterparty default risk. We can calculate the risk neutral expected loss from a default at a time ti, as the formula shown, where qi is the risk neutral probability of default, r is the expected recovery rate, fi is the value of a derivative to the financial institution, assuming no defaults, and E is the expected value in a risk-neutral world. The maximum between Fi and 0 is the exposure of the financial institution's potential loss at time Ti. The values now lead us to the concept of credit value adjustment, also named as CVA in the formula shown, where UI equals QI multiplied by 1 minus R, and BI is the value that pays off the exposure of the derivative at time Ti. Now reaching back to the three categories previously mentioned, in the first one, the value of Fi is always negative. Hence, it is foreseen that the total expected loss is always 0. Therefore, the financial institution does not need to make any adjustments for the cost of defaults. For the second category, Fi is always positive, so the expression F maximum between Fi and 0 always equals Fi. Supposing that the only payoff of the derivative at time t, then of its life. In this case, Fo must be present the value of Fi, so Bi is equal to Fo for all I. That becomes the first expression shown. One particular instrument that falls into the second category we are considering is an unsecured zero coupon bond that promises $1 at a time t and issues by the counterparty in the derivative transaction. Defines BO as the value of the bond assuming no possibility of default, and BO star as the actual value of the bond. If we make the simplifying assumption that the recovery on the bond as a percentage of its no default value is the same as than on the derivative, then we can obtain the second expression. If Y is the yield of a risk zero coupon bond maturing at the time t and E star and Y star is the yield on a free zero coupon bond issued by the counterparty that matures at time t, then we can obtain the following expression. This shows that any derivative promising a payoff at time t can be valued by increasing the discount rate that is applied to the expected payoff in a risk-neutral world from the risk-free rate y to the risk rate y plus. It is considering a 2-year over-the-counter option sold by a company X with a value assuming no possibility of default of $3. Suppose that the 2-year zero coupon bonds issued by the company X have yield that is 1.5% greater than a similar risk-free zero coupon bond. The value of the option is $2.91. For the third category of derivatives, the sign of Fi is uncertain. The variable Vi is a call option with Fi with a strike price of 0. One way of calculating Vi is to simulate the underlying market variables of the life of the derivative. When a counterparty wants to enter into a large derivatives transaction, a financial institution should be worried. When the transaction has a large negative value for the counterparty, the chance of the counterparty declaring bankruptcy may be much higher. Traders working use the term right-of-way risk to describe the situation where a counterparty is most likely to default when the financial institution has zero or very little exposure. They use the term wrong-way risk to describe the situation where the counterparty is most likely to default when the financial institution has a big exposure. The credit risk mitigation. In many instances, the analysis we just have presented overstates the credit risk in derivatives transaction. This occurs because the number of clauses of the derivative dealers include in their contracts to mitigate credit risk. One way is using netting, a clause that governs transactions in over-the-counter market is known as netting. This states that if a company defaults on one transaction, it has with a counterparty, it must default on all outstanding transactions with the counterparty. It can substantially reduce credit risk for a financial institution. For example, a financial institution that has 3 transactions outstanding with a particular counterparty. Their transactions are worth 10 million, 30 million, and minus 25 million. Then the counterparty runs into difficulties and defaults on its outstanding obligations, so these transactions now will have values of minus 10 million, minus 30 million, and plus 25 million to the counterparty, respectively. Without netting, the counterparty will have a loss of 40 million because of the default of the two first transactions. It will only retain the third. With netting, it is compelled to default on a 3 transactions for a loss to the financial institution of 15 million. Without netting, the financial institution losses can be calculated by the following expression, where the financial institution has a portfolio of n-derivatives transactions with one counterparty. Also, we can assume that there is no default value of the transactions that are made. This is represented by BI. Also, it is a loss is the payoff from a portfolio of call options where each option has a strike price of 0. On the other hand, with netting, the institution losses can be expressed as the second formula. The loss here is the payoff from a single option with a strike price of 0. The CVA analysis presented previously can be extended so that the equation gives the present value of the expected loss from all transactions with a counterparty when netting agreements are in place. This is achieved by defining BI as the present value of the derivative that pay off the exposure at the time TI on the portfolio of all transactions with a counterparty. This is a challenging task because it will be needed to calculate the incremental effect on expected credit losses. Hence, the incremental effect of a new transaction of expected default losses can be negative, which occurs when the value of the new transaction is negatively correctly with the value existing transactions. Another way to mitigate the credit risk is using collateralization. If the total value of the transactions to the financial institution is above a specified threshold level, the agreement requires the cumulative collateral posted by the company to equal the difference between the value of the transactions to the financial institution and the threshold level. If after the collateral has been posted, the value of the transactions move in favor of the company so that the difference between the value of the transactions to the financial institution and the threshold level is less than the total margin already posted, and the company can reclaim margin. In the event of a default by the company, the financial institution can seize the collateral. If the company does not post collateral as required, the financial institution can close out the transactions. We can see this on an example where we can suppose that there is a threshold level of a company is 10 million and the transactions are marked to market daily. If on a particular day the value of the transactions rises from 9 million to 10.5 million, it can ask for a 0.5 million of collateral. If the next day the value of the transactions rises further to 11.4 million, it can ask for a further 0.9 million of collateral. Here we can see that the threshold, in this case 10 million, can be regarded as a line of credit that the financial institution is prepared to grant the company. The margin must be deposited by the company with a financial institution in cash or in form of acceptable securities such as bonds. The securities are subject to a discount known as a haircut applied to their market value for the purposes of margin calculations. Collateralization agreements provide a great deal of protection against the possibility of default. However, the threshold amount is not subject to protection. This occurs because when the company gets into financial difficulties, in most of cases, it will stop responding to requests to post collateral. Another credit risk mitigation technique sometimes used by a financial institution is known as a downgrade trigger. This can be explained if the credit rating of the counterparty falls below a certain level, the financial institution has the option to close out a derivative transaction at its market value. Downgrade triggers do not provide protection from a big jump in a company's credit rating. Also, downgrade triggers work well only if the relatively little use is made of them.
Okay, so right now we're gonna talk about the default correlation. The term default correlation is used to describe the tendency for two companies to default at about the same time. There are a number of reasons why default correlation exists. Companies in the same industry or the same geographic region tend to be affected similarly by external events, and as a result may experience financial difficulties at the same time. Economic conditions generally cause average default rates to be higher in some years than in other years. A default by one company may cause a default by another, the credit contagion effect. Default correlation means that the credit risk cannot be completely diversified away and is the major reason why risk-neutral default probabilities are greater than real-world default probabilities. There are two types of default correlation models that have been suggested by researchers. They are reduced form models and structural models. The first one assumes that the hazard rates for different companies follow a stochastic process and are correlated with macroeconomic variables. When the hazard rate for company A is high, there is a tendency for the hazard rate for company B to be high. This induces a default correlation between the two companies. Also, reduced form models are mathematically attractive and reflect the tendency for economic cycles to generate default correlations. Their main disadvantage is that the range of default correlation that can be achieved is limited. The other one, the structural models, are based on a model similar to Merton's model. A company default is the value of its assets it below a certain level. Default correlation between companies A and B is introduced into the model by assuming that the stochastic process followed by assets of company A is correlated with a stochastic process followed by the assets of company B. Structural models have the advantage of a reduced form models that the correlation can be made as high as desired, and their many disadvantage is that they are liable to be computational quite slow. A model that has become a popular practical tool is the Gaussian copula model for the time to default. It can be, as a simplified structural model, it assumes that all companies will default eventually and attempts to quantify the correlation between the probability distributions of the time to default for two or more different companies. The model can be used in conjunction with either real-world or risk-neutral default probabilities. The left tail of the real-world probability distribution for the time to default of a company can be estimated from data produced by rating agencies such as the left tail of the risk-neutral probability distribution of the time to default can be estimated from bond prices using the approach on section 23.4. Define T as the time to default of company 1 and T2 as the time to default of company 2. If the probability distribution of T1 and T2 were normal, we could assume that the joint probability distribution of T1 and T2 is bivariate normal. As it happens, the probability distribution of a company time to default is not even approximately normal. This is where a Gaussian copula model comes in. We can see the formula in the presentation, where Q1 and Q2 are the cumulative probability distributions for T1 and T2 respectively. And n-1 is the inverse of the cumulative normal distribution. By construction, x1 and x2 have normal distributions with means 0 and unit standard deviation. The model assumes that the joint distribution of x1 and x2 is bivariate normal. This assumption is referred to as using a Gaussian copula. The assumption is convenient because it means that the joint probability distribution of T1 and T2 is fully defined by the cumulative default probability distributions Q1 and Q2 for T1 and T2 together with a simple correlation parameter. The attraction of the Gaussian coupler model is that it can be extended to many companies. Suppose that we are considering n companies and that Ti is the time to default of ith company. We transform each Ti into a new variable x1, and we have to apply the formula that we can see in the presentation. The Gaussian coupler is a useful way of representing the correlation structure between variables that are not normally distributed. So suppose that we wish to simulate defaults during the next 5 years in 10 companies. The coupler default correlation between each pair of companies is 0.2. For each company, the cumulative probability of a default during the next 1 to 5 years is 1%, 10%, 6%, 10%, and 15% respectively. When a Gaussian coupler is used, we sample from a multivariate normal distribution to obtain the xi, with the pairwise correlation between the xy being 0.2. We then convert the xi to t, a time to default, when the sample from the normal distribution is less than n minus 1, 0.01. This is equal to minus 2.33. We can see that every time that a number is less than n minus 1 and the number, this it's going to change. Okay, so to avoid defining a different correlation between xi and xj for each pair of companies I and j in the Gaussian coupler model, a one-factor model is often used. We can see the formula in the first part of the presentation. In this equation, f is a common factor affecting defaults for all companies, and zi is a factor affecting only company I. The variable f and the variable zi have independent standard normal distributions. Suppose that the probability that a company I will default by a particular time t is qit. Under the Gaussian coupler model, a default happens by time t when nxi is less than qit or xi is less than n minus 1 qit. We can see the conditions in the presentation. Conditional on the value of the factor f, the probability of default is therefore the first formula that we can see in the presentation, that it will be qi. And a particular case of the one-factor Gaussian coupler model is where the probability distribution of default are the same for all I, and the correlation between xi and xj is the same for all I and j. And in this case, we have to use the second formula that we can see in the presentation. Credit value at risk. This can be defined analogically to the way value at risk is defined for market risk. For example, a credit bar with a confidence level of 99.9% and a year time horizon is the credit loss that we are 99.9% confident will not be exceeded over 1 year. Consider a bank with a very large portfolio of similar loans. As an approximation, assume that the probability of default is the same for each loan and the correlation between each pair of loans is the same. When the Gaussian coupler model for time to default is used, the equation that we see in the first part is a good approximation, equal to the percentage of default by time t as a function of f. The factor f has a standard normal distribution. We are x% certain that its value will be greater than m minus 1 minus x, that it's equal as minus n minus 1x. We are therefore x% certain that the percentage of losses over t years on a large portfolio will be less than v, that we can see the formula for v in the presentation. This result was first produced by Bisek. Then we can see an example. Suppose that a bank has a total of 100 million of retail exposures. The 1 year probability of default averages 2% and the recovery rate averages 60%. The coupler correlation parameter is estimated as 0.1. We have to apply the formula that we see before and showing that the 99.9% worst case default rate is 12.8%. The 1 year 99.9% credit part is therefore 100 multiplied by 0.128 multiplied by 1 minus 0.6, or uh, 0.33 million, 5.3 million. Many banks have developed other processes. Many banks have developed other procedures for calculating credit bar for internal use. One popular approach is known as credit metrics. This involves estimating a probability distribution of credit losses by carrying out a Monte Carlo simulation of the credit rating change of all counterparties. Suppose we are interested in determining the probability distribution of losses over 1 year period. On each simulation trial, we sample to determine the credit rating change and defaults of all counterparties during the year. We then revalue our standing contracts to determine the total of credit losses for the year. After a large number of simulation trials, a probability distribution for credit losses is obtained. This can be used to calculate credit bar. This approach is liable to be computationally quite time intensive. However, it has the advantage that credit losses are defined as those arising from credit downgrades as well as defaults. Also, the impact of credit mitigation clauses such as those described can be approximately incorporated into the analysis that we can see on the table. It's typical of the historical data provided by rating agencies on credit rating change and could be used as a basis for a credit metrics Monte Carlo simulation. It shows the percentage probability of a bond moving from one rating category to another during 1 year period. For example, a bond that starts with an A credit rating as a 90.91% change of still having an A rating at the end of 1 year. It has a 0.05% change of defaulting during the year, a 0.09 change of dropping to B, and so on. In sampling to determine credit losses, the credit rating changes for different counterparties should not be assumed to be independent. A Gaussian Kappa model is typically used to construct a joint probability distribution of rating change similar to the way it used in the model in the previous section to describe the joint probability distribution of times to default. The Kappa correlation between the rating transitions for two companies is usually set equal to the correlation between their equity returns using a factor model similar to the one that we see previously.